Real estate professionals should be able to explain how to help protect your client from lending discrimination as well as how to navigate the mortgage process generally. Discuss the importance of pre-approval and how clients should manage their finances after being pre-approved through to closing. Provide troubleshooting tips for clients with low credit scores, who don't understand how to assess loan estimates, or who have a lender appraisal come in too low. Protecting your client from lending discrimination. The home mortgage process often presents a challenge for buyers. Lending discrimination happens when a lender makes an adverse action against someone based on a protected class. Lending discrimination might occur, for example, if someone is turned down for a mortgage based on their gender, race, or ethnicity, among others. Lending discrimination can also occur if offered a loan with higher, subprime interest rates when they might otherwise qualify for a loan with better, prime terms. This latter example often falls into the category of predatory lending. Due to abuses in the past decade, federal regulators have issued rules limiting predatory lending abuses. It's important for all potential homebuyers to know their rights and how to look out for discriminatory or predatory practices, and it's important for you as their agent to show them how. NAR identifies abusive and predatory lending practices as deceptive claims that can result in home equity stripping, ill-advised refinancing and reverse mortgages. Diminished personal credit standing, as a result of defaulting on a mortgage loan for which terms are not fully explained or understood. Violations of federal consumer protection statutes and regulations. Federal banking regulations define predatory lending as practices or loan terms that deliberately deceive borrowers, strip homeownership equity, or induce a borrower to refinance repeatedly with higher points and fees. This is not to be confused with higher risk lending products, which a lender is obliged to make available to a borrower. Here are some other examples of lending discrimination: denying a mortgage or charging a higher interest rate because the property is located in a majority-minority neighborhood. Providing a different customer service experience to mortgage applicants depending on their race, color, religion, sex, familial status, national origin or disability. Refusing to consider a mortgage applicant's disability-related income, such as SSI or SSDI. Steering a borrower to a loan with less favorable terms because of his or her race, color, religion, sex, familial status, national origin or disability. Targeting a minority community for fraudulent home loan modification assistance. As a real estate professional, you can assist your clients by being aware of predatory lending practices and helping them understand what to look for as they acquire their loan. Let clients make the decision about their financing options, or refer them to a range of responsible lenders, and then let them decide which lending option is best for them. Guard against predatory lending. A lender or investor tells your client that they are the only chance of getting a loan or owning a home. The house your client is buying costs a lot more than other homes in the neighborhood, but isn't any bigger or better. Your client is asked to sign a sales contract or loan documents that are blank or contain information that is not true. Your client is told that the Federal Housing Administration insurance protects them against property defects or loan fraud. It does not. The costs or loan terms at closing are not what your client agreed to. Specifically, the CD, closing disclosure form, does not match the loan estimate. Your client is told that refinancing can solve their credit or money problems. Your client is told that they can only get a good deal on a home improvement if they finance it with a particular lender. As well know, the home buying and mortgage process can be confusing and stressful, especially for first-time home buyers. The more you can help guide your clients through this process by advising and educating them on the various steps and possible missteps, the more valuable you become not only to them, but future clients, as your reputation grows. Here are some general tips that you can use to help demystify the mortgage process and help distress your clients. Do the homework on housing prices. In addition to what you know about the market, encourage clients to compare housing prices online. Not only will this help clients better understand the information and advice you provide, but such transparency. Build credibility and trust. Compare multiple lenders. If possible, provide clients with lenders that you've worked with before and trust. But also encourage clients to cross-check all lenders by suggesting they get lending terms from a few different firms. It's important to tell clients that a rate quoted on one day from one lender is going to be different than a rate quoted the next day from another lender. Rates change daily and sometimes multiple times a day, so rates should not be the only factor used when selecting a lender. And if you're just starting a relationship with a client, or a potential client, also caution them against anyone trying to steer them to one particular lender. Again, suggesting that clients take agency for their own housing journey will ultimately help build up their trust in you. Trust their affordability gut. The lure of owning a new home is powerful, so clients should listen carefully to their gut if they have doubts about how much of a loan they can afford. If they're concerned that they might be reaching for a loan that exceeds their means, they need to fully understand the consequences of taking on the risk. Worst case, they can't keep up with the payments and default on the loan, thus losing the house and ruining their credit for a very long time, which will make buying a home in the future far more difficult. Less worst case, but still significant, they can make the payments, but each month is a struggle and the everyday household budget is very tight. Such a scenario likely prompts stress and anxiety that can lead to a general diminishment of quality of life, as well as stress-induced health-related issues. It's important to remind clients to look at the long view of their home buying endeavor, not just the short-term thrill of the actual purchase. Be honest. The desire and pressure to buy a new home can tempt many home buyers to fudge the truth. The problem with this is that they are legally bound to whatever exaggerations or half-truths or lies they commit. This includes mortgage application information, overstating income, concealing debt, or falsifying employment history in any way might not only saddle clients with an unaffordable loan, but it's also fraud that might result in criminal charges. Realtors should be careful not to advise clients on how to complete a loan application. This might result in legal action, fraud in the factum or fraud in the inducement. Intended use of home. Emphasize to clients that they need to be honest about whether or not they intend to actually live in the home they are purchasing, rather than renting or flipping it, because not being honest about this also violates federal laws that could bring criminal penalties and charges. Know and understand what's being signed. In the pressure of the mortgage and home buying process, it's easy for less experienced and less knowledgeable home buyers to feel pressured into signing documents that they haven't fully read and likely don't fully understand. Emphasize the importance of not signing anything without fully understanding the full legal implications. Emphasize, too, why a reputable, trustworthy lender, as well as a legal professional, is so important in this process. Ultimately, when in doubt, ask for clarification and help. Your client helping clients distinguish pre-qualified versus pre-approved. It's not uncommon for clients to think getting pre-qualified and pre-approved mean the same thing. It's of course your job to clearly make them understand that they're not. Think of it in terms of shopping. Pre-approved is the shopper who's on a mission to buy, pre-qualified is someone who's just browsing. The difference to sellers is profound, which is why it's important that emphasize to your client the need to get pre-approved before they're ready to put a bid on a home. The pre-qualification provides an estimate of what a borrower might be able to afford, whereas pre-approval provides the exact amount a lender will extend to a potential home buyer. Obviously, the steps for pre-approval are more rigorous and time-consuming, which is precisely why it matters more when looking to buy a home. The exact procedure for both will vary somewhat, depending on the lender. Pre-qualification versus pre-approval. Pre-approval. Estimated income and savings, often self-reported. Exact income, verified with documentation, such as pay stubs and W-2. Estimated savings and assets, often self-reported. Exact savings and assets, verified with documentation such as bank records. Informal inquiry into credit rating, though some lenders may run a quick check. Formal inquiry into credit rating with credit reports from credit bureaus. Employment not typically verified. Employment verified, typically completed within a day, if not sooner. Typically takes days and sometimes multiple weeks. Estimated loan eligibility amount provided at conclusion. Exact loan eligibility amount provided at conclusion. Of course, you might find that some people do use the terms interchangeably, so ultimately what's most important is the process used by the lender. That is, the lender needs to verify W-2s, bank statements, and credit scores. The next tip helps ensure this process is done correctly. The sniff test. Ensuring pre-approval is actually pre-approved. A little-known pitfall in the lending and pre-approval process is that many times underwriting for pre-approval doesn't actually go through the formal underwriting process. Many lenders don't want to take the time to go through the full process unless they have an address for the property, which of course is antithetical to the entire concept of getting pre-approved. That is, the buyer wants to be ready to purchase a home before they know what the exact home is. On its face, a lender approving a client without fully examining their finances might sound like it makes things easier, but in actuality this can cause major problems down the road if a client signs a PA for a home they ultimately can't get a mortgage for. This costs the client not only time and money, but can be emotionally devastating to clients who thought they were about to buy, or sell, their dream home, only to find out that they cannot. It's important for the real estate agent on both sides, both the listing and buyer's agent, to do their due diligence in checking on pre-approvals because they have a fiduciary responsibility to their principals, their clients, whereas the lender is not a party to the contract. If the contract goes sideways or gets derailed, the lender is not liable in any way. Fortunately, Realtors in the know can avoid this headache and heartbreak entirely by taking a bit more time to look out for the interests of your client, your fiduciary duty, as well as cultivating the services and strength of your business. Develop relationships with lenders. Many real estate agents see the lending aspect of the home buying process as separate from their role, but in fact it's integral. Success in real estate is predicated on developing and maintaining strong relationships. It's not different when it comes to lenders. Don't try to be the expert on financing. Instead, take time to develop strong relationships with a few different lenders. Over time, as you develop trust, you can use them as a resource to bounce questions off when needed, and you can also rely on them to do the right thing when it comes to all things lending related, from offering your clients fair rates to properly and fully vetting clients in the pre-approval process. Ideally, these lenders can become part of your team. Conduct a sniff test. It's important to follow up with lenders, with those you know, and especially those you don't, about all facets of the lending process. You want to make sure that you sniff around to make sure all aspects of the underwriting process are working as they should. This can be of great value to clients at the very earliest of stages to ensure that when they're ready to buy, they actually have the proper pre-approval in place to do so. Some questions you might ask a lender. How long have you been in lending? How pre-approved are they? Have you talked to or met with our clients? What paperwork have you received? Have you verified funds to close escrow? Is the client's loan in the system? Have you run a DU and AU? Are there any outstanding conditions not met? Have you pulled a tri-merge credit report? What is your appraisal delivery time? Can you close on a 21-day close of escrow? Managing finances after pre-approval. Once a mortgage lender has issued pre-approval, your client will want to avoid any financial activities that deviate from the information the lender pre-approved, such as credit rating, savings, and debt-to-income ratio. Any changes in a borrower's finances, even activities that might otherwise seem beneficial, like paying off debt, could raise flags for the underwriter, which can lead to loans getting denied as a worst case or delayed as a best case, and in a hot market a delay in financing might ultimately end up with losing out on a home. Ultimately, you want to counsel clients to maintain the status quo. Here are some tips to avoid these potential pitfalls in the mortgage process. Avoid large purchases. After having gotten pre-approved from a mortgage lender and signed a purchase agreement for their dream home, your client might be wanting to fill that home with lots of new stuff, new dining room sets, appliances, a new car for the new driveway. Tell them to wait. They don't want to change their savings or their credit rating at this time. There will be time enough to make all these purchases after closing. Do not change banks or bank accounts. Changing accounts at this critical time will invariably delay the process because underwriters will then have to verify and check all of these new accounts. Recall from earlier in the course when we discussed how lenders check to see if a borrower's deposits are seasoned, which means they've been in the account for at least 60 days. Changing accounts essentially means that underwriters then have to verify that any deposits in the new account have been seasoned all over again. Avoid unverifiable, large deposits. Large deposits raise a flag of an illegal gift. That is, a gift from a party that stands to benefit from the closing of a home sale. Any large deposits will require documentation to verify that the deposit is, in effect, legal. According to Fannie Mae, a large deposit is a single deposit that exceeds 50% of the total monthly qualifying income for the loan. It's not as if large deposits, or even gifts, aren't allowed during this time frame. Borrowers just need to be aware that any such deposits will draw scrutiny and require verification from the lender, which could delay the process. So if it's not absolutely necessary to make such deposits while waiting for the mortgage to be approved, counsel clients to wait until after closing. Do not open new credit lines or pay off large credit card debt. The takeaway here is to not engage in any activities that would alter credit ratings because, again, these ratings would deviate from the financial information that was initially checked for pre-approval. All of your clients' activities should persist as it had been. So counsel them to continue to make credit card payments on time and as they had been, and hold off on any drastic changes until after closing. Additional considerations. If it's not apparent already, it's best to avoid any major changes in their lives, including their finances but also their livelihoods. If your client is actively looking for a new job, suggest them to hold off on making any definitive moves until after closing. As with other dramatic changes, such a move will either result in rejection or major delays in the underwriting process. Similarly, the time between signing a purchase agreement and closing on a home is not the best time to be overly generous with family and friends. Do not make lavish donations nor co-sign on a loan. Strategies to improve credit rating. For those clients who may not have ideal credit ratings, All is not lost. Credit ratings can be improved, but be sure to tell your clients that they need to be disciplined and patient. Credit ratings aren't going to improve overnight, so the earlier they can begin working to improve their credit scores, the better. Some factors that lower credit scores include late payments on credit cards, car loans, student loans, mortgage loans, credit cards close to maximum limit, outstanding collection accounts or charge-offs, tax liens and judgments. Here are some tips to share with clients to help them improve their credit scores, or ensure they maintain good ones. Don't close credit lines. Closing credit lines can hurt your credit rating. Here's why. Part of the calculation into what a borrower owes is the credit utilization rate, or the amount a person owes in relation to the amount of their overall credit available. Opening new lines of credit. Once a client has active lines of credit in good standing, they should avoid opening additional lines of credit. Each new line leads to credit inquiries that over time could decrease a credit score. Opening new lines also then decreases the average age of all your credit lines, which also is a knock on your credit rating. Hire a credit repair company. For clients who are desperate to improve their credit ratings quickly, there are credit repair companies that work with creditors and the credit bureaus to help find ways to improve scores. Comparing loan estimates. Clients should apply for mortgages from multiple lenders and receive a loan estimate from each showing all fees so they can do an apples-to-apples comparison and then choose a lender by giving them intent to proceed. Here are critical items your clients will want to look for in comparing loan estimates. Is the rate locked? Did they want it to be? Is the loan amount what they are expecting? Is the rate fixed or adjustable? What were they expecting? Does the loan have a prepayment penalty? Is the estimated total monthly payment acceptable? Section 800 Fees on the loan estimate. What are the origination charges? What are the charges for the credit reports? What are the charges for the home appraisal? Is the homeowner's insurance premium accurate? Are the property taxes accurate? Is the estimated cash to close as expected, and do they have sufficient funds to pay as required? If the home appraisal derails process, all mortgage lenders will appraise the value of the home to ensure the value of the home matches the amount of the loan. When properties appraise below the agreed sale price, it's a big headache for buyers, sellers, and real estate agents. The transaction comes to a halt unless the issues can be resolved. The first step in trying to resolve the situation is by helping your client understand the contract, including any appraisal and financing contingencies, so they can evaluate their options before deciding what to do next. One option may be to walk away. If an appraisal contingency allows, the buyer may elect to cancel the contract and receive a refund of their earnest money. If the buyer wants to go forward, here are some options to consider. Check the appraisal report for errors like mistakes in square footage or overlooking a room. Ask the appraiser to review their report and value estimate using different comps. Note, though, that revisions tend to be rare unless the error is really glaring. Ask for a second opinion review appraisal. Assess if the appraisal is too low or the home is overpriced. Renegotiate the sales price. See if the buyer can pay the difference in cash. The Dodd-Frank legislation of 2010 brought many changes to the real estate industry in an effort to bolster consumer protections, one of which was to make the closing process, and the associated costs, more transparent for the buyer. This was accomplished by what was previously multiple forms into one consumer disclosure and to extend the timeline that the buyer had to review and sign it. It's the final document in the mortgage process that your clients will see before closing. The disclosure shows all the expenses and expected payments associated with the mortgage. It will include interest rate, fee and closing costs, monthly mortgage payment, total of all payments, costs, and charges. The lender is required to give the borrower 3 business days from the date of receipt of the forms to review, approve, and sign. If the disclosure is mailed to the borrower, another 3 business days must be added to the review period, which could then in total amount to 6 business days. It's important to note that buyer cannot waive this review period, and lenders are strictly bound to comply with the timeline.